The financial statements must present fairly the financial position, financial performance, and cash flows of an entity. Fair presentation requires the faithful representation of transactions and events in accordance with the definitions and recognition criteria in the framework. The application of IFRS is presumed to achieve fair presentation. IAS 1 requires an entity whose financial statements comply with the IFRS to make a statement of such compliance in the notes. IAS 1, however, acknowledges that in extremely rare circumstances, management may conclude that compliance with an IFRS would be so misleading that it would conflict with the objective of financial statements in the framework. In such a case, the entity is required to depart from the IFRS with detailed disclosure of the nature, reasons, and impact of the departure. IAS 1 requires management to make an assessment of an entity's ability to continue as a going concern. If management has significant concerns about the entity's ability to continue as a going concern, the uncertainties must be disclosed. If management concludes that the entity is not a going concern, the financial statements should not be prepared on the going concern basis. Financial statements, except for cash flow information, are on the accrual basis of accounting. The presentation and classification in the financial statements must be retained from one period to the next unless a change is justified either by a change in circumstances or a requirement of a new IFRS. Each material class of similar items must be presented separately in the financial statements. Dissimilar items may be aggregated only if they are individually immaterial. Assets and liabilities and income and expenses may not be offset unless required or permitted by an IFRS. IAS 1 requires that comparative information be disclosed in respect of the previous period for all amounts reported in the financial statements, both on the face of the financial statements and in the notes, unless another standard requires otherwise. Comparative information is provided for narrative and descriptive where it is relevant to understanding the financial statements of the current period. IAS 1 requires that the name of the reporting entity, where the financial statements are of a group or an individual company, the reporting period, the presentation currency, and the level of rounding must be disclosed and displayed prominently. There is a presumption that financial statements will be prepared at least annually. If the annual reporting period changes, the financial statements are prepared for a different period. The entity must disclose the reason for the change and state that the amounts are not entirely comparable.